Hey there, Brad Castor from GreatOptionTradingStrategies.com. Got a fun video for you today, although it's taken me some time to put it together because there were so many different ways I could have gone with this. Today we're going to look at a Lululemon put selling for income trade we did inside the Leveraged Investing Club a few weeks ago, back at the end of June, that just worked out beautifully. And if you approach all your trade entries like this, I think you're really going to like the results. Also, stay tuned because I'm going to show you how to catch a falling knife. But first, some quick background. The Leveraged Investing Club is my private membership option trading site that I launched back in 2012. The good news is that all memberships are lifetime memberships with no recurring subscription charges beyond the initial very reasonable one-time investment to join. It's pretty easy to recoup that one-time investment so that after that you're getting the club for free and forever, or until one of us dies. It's a kick-ass community of friendly and supportive traders of all experience levels and backgrounds. We have a lot of fun, and we also make a lot of money. The bad news is that it's actually not that easy to get into the club. I only offer it to readers of my daily option tips and insights newsletter, and even then, the readers typically only get one invite to join per calendar year. Of course, that means since I'm not selling and spamming you every day with the newsletter, you're actually getting, as the name says, good quality, actionable option trading tips and insights while you wait for your invite. More good news. Getting the Daily Tips newsletter is much easier than getting into the Leveraged Investing Club. You can simply download any of the free ebooks, guides, or special reports on the Great Option Trading and Strategies downloadable library page, and you'll automatically begin receiving the newsletter. Or you can also sign up for the newsletter directly. I put a link to the downloadable library page in the description below, and I pinned a direct link to the Daily Tips sign-up form in the comments section. So if you want to work with me at some point in the future and have me help you find great trades like the one we're going to go over today, you might get that process started now by making sure you're subscribed to the Daily Tips newsletter. Okay, with that out of the way, let's have some fun and start playing with falling knives. Now, I'm probably going to put together a more comprehensive case study on this trade because it was arguably a perfect put selling for income trade. And by that, I mean not only did the trade work out beautifully, but that the principles and process from the selection and setup and entry to management and exit, which we followed to a T here, really proved themselves. But for the sake of today's video, I mostly want to focus on the timing of the trade entry. So Lululemon reported earnings after the market closed back on June 5th, 2025, and it didn't go so well. The next day was the definition of ugliness itself as the stock closed down more than $65 a share. That was just shy of a one-day 20% shellacking, which of course, as we all know, is an official market term. The afternoon before the earnings release, Lulu closed at $330.78 a share. The next day, shares ended at $265.27 a share. Now, from a technical analysis perspective, 240 was an easily identifiable key support level, which lined up with the earlier tariff sell-off lows from April in the aftermath of Liberation Day. So it would make sense to sell $240 puts on Lulu at that point, right? Not only did that provide a good amount of further downside buffer, as in another $25+ a share, it was also at a key support level. Plus, thanks to the big sell-off in shares, premium levels were nice and plump. Sounds like a nice, easy, lucrative, and conservative payout, right? Now, I hate stock market adages and conventional wisdom, but this time the cliche, don't try and catch a falling knife, definitely applied. Because Lulu was not done falling. Key support levels be damned. As in the stock continued to trade lower the next day, and the day after, and the day after that. Holy cow, the shares kept trading lower for 11 consecutive trading sessions. Now, there was one borderline up day around the 240 level between the two larger red candle days, but you get the point. How to actually catch a falling knife. So this is a point I've made many times over the years inside the Leveraged Investing Club. Catching a falling knife is actually very easy. All you have to do is wait for the knife to stop falling and then go over and pick it up off the ground. We actually had some club members jump the gun and sell puts at that $240 strike price while Lulu was still in sell-off mode. Don't get me wrong, 240 was a viable bottom, and as you can see in the chart, Lulu did spend 3 trading sessions in that area. And that totally makes sense. It was a key area. But you never truly know where the floor in a stock is ahead of time. You can identify where the likely battleground spots are and whether bulls or bears are favored, but unless you have a working crystal ball, you have to let the market sort things out. and 240 did not, in fact, turn out to be the bottom, which is perfectly fine by me. That's because I was content to sit on the sidelines and patiently wait for an actual indication that the stock was done falling and that the worst was over. And it did require patience. I watched and waited for more than 2 weeks until the stock finally gave an actual indication that the near-term bottom was in. LULU finally bottomed on Monday, June 23rd with an intraday low of $219.97 a share. Importantly, the stock bounced strongly off those intraday lows later in the session. 220 was also a key level going back to the stock's lows from the previous August. And the next day, Tuesday the 24th, there was a continued strong bounce and follow through so that I finally felt confident enough to enter a put selling trade. So with the stock trading at $232.28 a share, I entered an official club trade selling a LULU July 18th, 2025 $220 put for $3.40 a contract. Remember, 220 is where the stock support level proved itself and held. Now, if held until expiration after commissions and fees, that would work out to be a very nice 21.52% annualized rate over 24 days. Inside the club, we target 15 to 25% annualized returns on new positions, so this was right in line with that. Now, let's see how the trade worked out. As you can see, LULU continued to rebound all the way up to around the $250 share price level on an intraday basis. As a reminder, there are 3 ways a put can lose value, which as put sellers, we want, of course. And that's number 1, passage of time, number 2, a rising underlying stock price, and number 3, a decrease in implied volatility levels. With the LULU trade, we got all 3 factors working for us. But it was mostly a rising share price, as 7 days after we entered the trade, the stock was trading higher by more than $15 a share, from $232.28 to $247.67 a share. And that's when I officially exited the trade. Now, I'll explain why I exited at that exact point, but let's look at the final results of the trade first. So on June 24th, LULU trading at $232.28 a share, I sold that July 18th 220 put for $3.40 a contract. Fast forward 1 week, and on July 1st, with LULU trading at $247.67 a share, I bought that $220 put back for just 80 cents a contract. Final book gains were $259.08 after commissions and fees for a whopping 56.29% annualized ROI over 7 days. The original terms had been 21.52% annualized, projected over 24 days if held until expiration. Now, there are 2 reasons why we exit a winning trade earlier, and I covered this in depth in a recent video, which I'll put a link to at the end of this video. And those 2 reasons are that the remaining time value gets too small to justify keeping the trade open, or if we get some kind of technical analysis warning sign. In this case, there probably was a technical case that the stock was beginning to slow down and that there wasn't a lot of further near-term upside left in LULU's bounce off those oversold lows, so that there was an increased risk of a pullback. And in fact, that's how things did play out as the stock traded back down into the 230s. At the time of this video, there's still a week left before that July 18th expiration date, and the stock is still comfortably above the $220 share price level. But it's also well off those earlier highs around the $250 share price level. But the main reason I pulled the plug on the trade and locked in gains after just 7 days of a 24-day trade is because of that remaining time value factor. Because what we left on the table, the $80.54 it cost to exit the trade, annualized at just 7.2% over the following 16 days, so it was a super easy decision to exit when we did. What that means is that if we wanted that last $80.54 per contract sold, we would need to keep the trade open for another 16 days and accrue those final gains at only a 7.20% annualized rate. That's extremely capital inefficient and an insult to your money, in my view. You may have to sometimes accept those kinds of rates if you've got a repair situation on your hands, but for a winning trade, it's simply not worth the risk of keeping a trade open for such paltry returns. And there are likely much better paying opportunities out there. Okay, quick bonus editorial comment here about timing trade exits on profitable option selling trades. I know there are those with more statistical and probabilistic mindsets who subscribe to the idea of closing out any trade once you reach a certain threshold, such as when you can lock in 50% of your gains. I totally understand that everyone's brains are wired differently, and if that approach resonates with you and works for you, then by all means continue. But to me, managing your trades that mechanically is just nuts. You're going to leave so much extra money on the table doing that. Managing your trades based on remaining time value and or near-term technicals is so much more efficient and still removes a lot of downside risk. But unlike rules-based trading, which doesn't require any expertise, just obedience, principles-based trading is predicated on the idea that you take everything on a case-by-case basis and make informed decisions based on actually understanding the underlying principles of how these trades work. So sometimes I may leave more money on the table than I'd like because the technicals are flashing a warning sign. And when those warning signs prove prescient, believe me, I'm happy I heeded them and accepted smaller returns. But sometimes I'm able to lock in a whole lot more than 50% of my max potential gains in a very short time frame. And thanks to the annualized metric, I can truly optimize my exits on winning trades. It's like being the old-time captain of a ship. Do you really sail the same exact way regardless of ocean or weather conditions? If you do, I'd advise you to not stray too far from the shore. Okay, off my soapbox now. All right, to wrap up things here, as I said earlier, this trade has a lot to teach, and I could have taken this video in several different directions. And I am planning on putting together a more comprehensive case study because it really is such a rich trade. But what I really want to emphasize today as the key takeaway is the importance of waiting for as long as it takes until you get a quality put-selling trade set up. In this case, we waited for 11 long trading sessions before we finally got evidence that LULU was done falling in the near term and that it was safe and smart to sell puts. And then, big surprise, right? The stock continued rebounding nicely for us so that we were able to exit way ahead of schedule for fantastic returns. A mistake I see a lot, and which I'm still guilty of myself from time to time, is to force trades that aren't quite there yet. LULU is a perfect example. That 240 area really did look like a key support level. So I understood the temptation to pull the trigger early and sell puts there before there was confirmation that 240 would in fact hold. At the time I'm recording this video, LULU is trading in the mid 230s. So the July 240 puts are now in the money. That doesn't mean anyone who sold those 240 puts are screwed. The position is only a little in the money and LULU options have pretty attractive premium levels. So that trade is very repairable and should still produce pretty good returns when the dust finally settles. But it was also a complication and situation that was totally avoidable. Bottom line, know what you're looking for when it comes to a trade setup and then be patient, be patient, be patient, and let Mr. Market come to you. Okay, if you enjoyed this and want more, be sure to check out the channel's other videos. I did take a few years off from YouTube, but I'm back now and trying to add 5 to 10 new videos per month. Also, sign up for the Daily Tips newsletter via the pinned comment below. Options are seriously like having a superpower, and I can show you how I developed mine, and I can help you develop yours. You can sign up directly, or there's also a link in the description section below to the Great Option Trading Strategies downloadable library page. Download anything from there, and you'll also begin receiving the Daily Tips newsletter. Heads we win, tails Mr. Market loses. That means you should be coming out ahead on virtually all of your trades. I love repairing trades because it's something that shouldn't be possible. But the more patient and disciplined you are with your trade setups, the fewer trades you'll need to repair. And that really should be the goal. Okay, until next time.